Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50 year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
All right, let's kick this thing off. Good evening or good afternoon, everyone. My name is Niyi Adewole, and I want to say Ekabo to everybody. And for those who are new here, Ekabo means welcome in Yoruba, hence Ekabo home really means welcome home. And tonight I want to welcome you into a conversation about getting things moving from a lending perspective. Because the thing is, most buyers spend months looking at houses and about 10 minutes thinking about the actual loan. And that's a little bit backwards because that loan is going to help determine the cash flow that you can make off of that property and whether or not you can even go after that property and go from there. I've personally used just about every type of loan that we're going to cover tonight, starting with, my first house hack back in 2016 when I bought a triplex using an FHA loan, and ending with the bank statement loans that I recently used and commercial construction loans that I recently used to build the self-storage from the ground up. And so we're going to cover a lot of different loan products. As we're going through this, please, if you have any questions, whether it's about this or anything else, just throw it into the Q&A. We will get to that at the end and make it happen for you. So feel free to ask any questions as we go along the way. But the first loan we're going to cover is FHA loan. And the FHA stands for Federal Housing Administration. It's a government-backed loan. The government is backing the magic, and they're the ones that are allowing you to put the minimal amount down of 3.5%. And they're also the ones that are helping subsidize that loan should that loan go bad. That's why the bank feels good lending you with as little as 3.5% down. As I mentioned before, the first property that I purchased was a triplex in Louisville, Kentucky. And at the time, I was 24, right? And so I was just fresh into my new job and I had saved up as much as I could. And all the money that I had saved up was in the amount of about $5,000. Because of this loan product, I was able to go in, buy a triplex for $190K. You can't do that today, at least not for that price. Those prices have increased, but that 3.5% down loan allowed me to do that. Not to mention, it also lowers the credit amount that you actually have to have. So your credit does not need to be perfect when you're using an FHA loan, again, because it's backed by the government. And so when you think about the median price of a property today, right? The median price is about $400K across the country. If you use an FHA loan of 3.5% down, you're able to put down as little as $14,000 compared to if you went conventional 20%, you'd be putting down $80,000, right? That's the difference of maybe 5 years of savings and trying to even get in the game that you could have already had a property. And so I'm a huge fan of FHA. I already mentioned that they're lenient on the credit, right? And they also allow you to get the advantage of being able to negotiate up to 6% in seller paid credits from the seller. And this is something I did in that deal as well. And so when you look at seller paid credits, this is another way that the government is able to incentivize personal home ownership versus investors buying. Typically, if I'm an investor and I'm going to go buy this house, right, for the median price, the max amount of seller credits you can get toward closing is 2%. And so a $400,000 property, right? And I wish I had my notepad to map this out. I'll bring it next time. But a $400,000 property is going to cost you, or you're going to be able to get about $8,000 toward closing, which may cover a portion of your closing. And you probably still got to come out of pocket for not just the down payment, but the rest of your closing costs. Whereas with an FHA loan, right, you can get up to 6%. And so if you're doing the math on that, that's 24K, right? Instead of 8K that you can get toward closing costs. Right. And it's going to knock out your whole closing. And in some instances, you can use the rest of that money to buy down the interest rate. We have a client that we helped buy a fourplex a few years back when interest rates were going up. And in that deal, we negotiated getting the 6% in seller credits, the full 6%. It equated to about 30K, right? And we were able to use that money to cover his closing costs and to buy his interest rate down from a 6% to a 3.5%. And that changed the numbers significantly and allowed it to work for him as a house hack. And so those are some of the benefits of the FHA. Now, some of the cons, right? When you look at buying a property, if you put down less than 20%, and it doesn't matter what type of loan type, if you put down less than 20%, you have something called PMI or private mortgage insurance that's added to your monthly note. And this is to cover and help the Fed kind of cover, or the government cover, if somebody defaults on their mortgage. They have that little extra cushion to kind of make it all right with the bank. And so when you look at that piece, when you're putting down for like a conventional loan, once you hit 20% ownership, or that home appreciates to where you own 20% of it, that PMI drops off. And that PMI can be as much as a percent or so of the actual purchase price, or 0.5% of the purchase price on a monthly basis. So on that 400K, let's say you're paying $200 a month in PMI, that's kind of a lot of money. That's never going to go away until you pay that mortgage off if you got an FHA loan. But if you had a different kind of loan, once you get to 20%, that PMI goes away, and now you save an additional $200, right, per month. And so that's one piece. The other thing is property condition standards. If you're getting a regular FHA loan, it has to be livable, and the appraiser is also going to be an inspector that needs to check out certain pieces of the property. And even if you've negotiated with the seller to where they're going to get it done, after closing or something of that nature, you still, especially with some lenders, have to get it done even before closing. We had an instance once where I was helping a client buy a duplex that had a basement that he was going to convert into like a triplex. And in that basement, there was mold. And the seller gave us a bunch of credits that we were going to use for a contractor post-closing. But long story short, what happened when the appraiser went out there is they're an inspector as well. They flagged it, and now the lender would not close on that deal until we had it remediated before. And so we had to work out some weird amendments, to be honest, to kind of make that happen to where the seller could actually get it done, because they didn't have enough money to pay out of pocket, and knock that out before closing. And the inspector had to come back out and re-inspect before we could close on that deal. And then the FHA, the last thing is it's usually a one-time loan. You can usually only have one FHA at a time, right? And so if you buy that first property, like I bought in Louisville, that was my FHA loan until I sold or refinanced that property. And after doing that, you can go get another FHA, but you can only have one that's active at a time. And so FHA is a low barrier to entry, but if your credit and savings are a little bit stronger, that's where conventional comes in, right? So FHA is kind of like, hey, if you really just need to be able to get in, do that, right? But the next step up is conventional. And the cool thing about conventional is when you move into this realm, if your credit's a little bit better and you're buying a personal home, you can put down as little as 3% now. Now, typically it's about 5% on a personal home, but sometimes if your credit's super strong, you can put down as little as 3%. And the benefit of conventional over FHA is that you are able to have that PMI drop off once you hit 20% ownership, whether that means you pay down the loan 20% or a combination of paying down the loan and the value of the property going up. And so this is the cool thing about real estate. One of the properties I bought when I moved out to Atlanta in East Atlanta Village, when I purchased it at that time, it was, mid-pandemic, it was $670K, right? And I put 5% down to buy that house. Fast forward about a year and a half, 2 years, that house was worth about $870. And so it appreciated quickly. And so what I did is I called up the lender and said, hey, I believe that I have 20% ownership in the house. It's appreciated significantly, right? Based on these recent comps. They sent an appraiser out to the house. They appraised it at a much higher value, right? And they dropped that PMI off because they now believe they have 20% equity in the house. And so that's how that works real time. Now, that's not a normal scenario. Typically, a house is not going to appreciate, 30% in a year and a half. That's kind of a lot. But when it does happen, it's a nice icing on the cake. The other piece is when you look at, the conventional route, if you're going to go and put down for an investment property, it's typically a bit more, right? In the past, when you were buying a duplex, triplex, quadplex, whether it was personal or investment, you were going to be putting down a minimum of about 20%, maybe 25%. Now, as of 2 years ago, really like a year and a half ago, they implemented a new rule where if you're buying it as a personal home, you can now consistently put down 5% on a duplex, triplex, quadplex, which is freaking awesome. And so if you're willing to sacrifice a little bit and, delay gratification, this is one of the strategies that I harp on, is just buying at least one house a year, right? Or one duplex, triplex, quadplex a year that you can live in one unit, rent the others out, and play offense and defense. Offense in the fact that you are getting an investment property that's going to be highly sought after and give you wealth over time. And defense in the manner that you have to have somewhere to live. Why not have somewhere that's paying you to live there and helping significantly cut down on your biggest expense, which is living? So if you put down 20%, there's no PMI at all, right? You typically get a lower rate, right? And your lower payment equals better cash flow, right? But you're putting down 20%. You're putting down a heck of a lot up front. So in that same example we used before, before, you're going from potentially putting down less than 15,000 to now putting down 80K to really get the full benefit of buying a conventional loan house, right? Now, if your credit is bruised and you're a first-time buyer and your cash is tight, I think FHA is an awesome way to go. That's how I got started. If your credit's pretty solid and you've been working for a bit and you've saved up some funds and you can get to that 5% level, I think conventional is a solid way to go because you get that PMI that's going to disappear. Again, I just want to reiterate, feel free to throw any questions in the chat, whether it's on this or anything else, and we will get to it at the end. The next loan that I want to talk about is DSCR loans, right? And this stands for debt service coverage ratio loans. In the realm that I'm in right now, where I no longer work a W-2, I'm full on 1099, and I do take a lot of deductions because I'm 1099 and I can. Getting a conventional loan is really tough. When you're not showing a lot of income on your taxes, that's what they look at for the conventional loan. Like, hey, what did you make after all the deductions, quote unquote? And so on paper, it needs to look like a lot more to get the conventional. The cool thing about DSCR is they don't look at that. They're looking at the property itself to say, hey, is this property going to generate enough income to cover the mortgage plus some? And that ratio may be, 1.1, 1.2 on the mortgage, where if the mortgage is $3,000 a month, you got to make sure that the house is bringing in at least, $3,600 a month to make them comfortable, or $3,300 a month to make them comfortable with lending that piece. But all you have to do with a DSCR is essentially bring that down payment and make sure you find the property that is going to produce enough. With DSCRs, I've seen people be able to put down as little as 15%. And I've also seen it go up to, 25, 30%. It pretty much can always go up. I'm looking for how little I can put down in most deals, because that will increase your cash on cash return if you're able to get in for a lot less. And so some of the benefits of DSCR is that you don't have any income documentation, right? This was something that would drive me crazy over time, because I have so many different avenues that they just be asking questions about all these different mortgages and like, okay, well, give me all the lease agreements to offset those. And then, you got your W-2, you got the stock portfolio, you got all this stuff, right? And you got to keep turning in all these documents. With DSCR, it's pretty cut and dry. They're looking at the property itself, making sure you have the down payment and reserves, and making sure it's going to cover it, and you're off to the races so you can move relatively quickly. You can scale without a ceiling, right? When you're using conventional loans, it typically caps the number of properties you can buy right around 10. I don't know if that's shifted up or down in the past few years, but right around 10 is where the banks will no longer lend to you conventionally. With DSCR, because they're looking at the property itself, it's not looking at you. So they'll continue lending as long as you find deals. DSCR is kind of cool because it allows you to close in your entity's name. Like you can close it in an LLC because, again, it's almost like a commercial loan. This was been available for commercial side. Like when I was building the storage from the ground up, this is available for you, right? If you want to refinance into a DSCR, you absolutely can. That's how they do it on the commercial side. But now it's creeped into the residential side. And this is one of the headache relievers that I go to. But it does allow you to close in an LLC. And taking a step back, you can't close an FHA or a conventional personal home, and really even investment home, in an LLC. You need to close it in your personal name because that's what they're lending on. They're lending to you. They're trusting that you can pay this back if anything happens with the property. And that's where the comfort comes from the bank. And then after closing, usually I'll wait 30, 60 days. That's when you can quit claim the property, at least the title of it, into your LLC's name so that you have that protection. So mortgage in your name, LLC after 30, 60 days of closing into the LLC's name, the property, the title into the LLC's name. And then also it works for short-term rentals. DSCR, especially in recent years, has been awesome for short-term rentals. Again, there were some instances, at least back in 2020, 2021, where you could put down as little as 15% with the short-term rental, as long as you had like history and things of that nature. And now it hovers between 15 and 25%, but it's freaking incredible for being able to get one of those awesome deals. And we've helped a couple clients even buy, a luxury short-term rental that needs to be renovated. They'll use hard money to get it renovated and then refinance it into a DSCR loan, right? Where they're pulling the capital back out and making it rock and roll from there. Now, some of the trade-offs, again, you may have to put down a bit more, 20 to 25%. We've seen as well that 15% was kind of like a short-lived thing. And the reason for that is for the bank, they want to make sure that if something goes wrong, you're incentivized to fight to keep the house. Because the last thing the bank wants is the house back. But as long as they have a high equity position, meaning, hey, you have 20% in the deal, they know that you're probably not going to want to give that back and lose that money. That's one. And two, if you do, then they can sell the property at a discount and still be made whole because they have that 20% up front. The other piece with DSCR, right, is when you are working through this, you're going to have a higher interest rate, right? So conventional has pretty good interest rate. That's like the best you can do if you're doing personal. And then FHA has a really good interest rate. It's even a little bit lower than that. DSCR is higher. Typically, it's a point, maybe a point and a half higher than what you're getting for a conventional, right? More FHA. And that just comes with the territory. So when you're running your numbers, you just got to be ultra conservative with that and make sure that the property still works. Now, DSCR is for the investors in my mind that are past their first couple deals. You've either maxed out your conventional loan slots or you're going after something that's a little bit more unique, right? Like that burster I was talking about, where you're going to renovate, a luxury short-term rental and then go back and refinance it. It's good for if you're self-employed and tired of doing paperwork, and if you're taking a lot of tax deductions because the taxes don't necessarily reflect how much you're actually making. Number 4. The next one we're going to go over is VA loan, and this very much resembles the FHA loan with slight differences. With FHA, you got to put down 3.5%, right? With VA, because you are a veteran and you serve the country, you actually get to put down 0%, which is incredible. So you can get into a property with no money in, and as long as you run the numbers and they work, it's basically an infinite return because you didn't have any money in. The other piece is they allow you to have up to 4% in seller credits, right? So it's not the 6% that you get with FHA, but 4% is still pretty good. That should cover your closing costs. It may not allow you to buy down the interest rate much, but your closing costs should be covered in that 4%. And again, you're bringing 0 to the table. So typically when we help a VA client, they're able to put down their earnest money because you still need to do that. And then at the closing table, they basically get a check for their earnest money back, which is kind of cool. So it's like, okay, you put this down to show that you were serious about the property, and now here goes your money back. And so you're getting paid to essentially buy the property, which is pretty awesome. When you look at the rates, VA rates tend to be very close to, the FHA rates. It kind of flows in that realm. And when you talk about the entitlement that comes with it, right, that tells you exactly how much you can use of it. And a lot of people don't know this, but you can use the VA loan multiple times as long as you stay within the amount that they've allotted for you. And so let's say your entitlement's $2 million, right? You buy a $500,000 duplex. You still got $1.5 million that you can use on other property that you're going to quote unquote live in after, a year, and kind of go from there. So that's one of the benefits. Now, the trade-offs, VA comes with a funding fee, and this funding fee is typically around 2% of the purchase price. Now you can roll this into the loan, or you can try to take some of the credits from the seller and use that to pay that funding fee. But it does come with a funding fee to help subsidize this and protect the lenders. And it's roughly around 2%. And then this is only for primary homes, right? It can't be for an investment home. It's for a primary that you commit to living in at least 1 year. And so you have to have that commitment there. And then like FHA, right, the property standards are a bit stricter. That inspector, or really the appraiser, is also an inspector, and they can point out multiple things that need to have some work. Just to reiterate, before we jump into the bonus loan types, because we are coming up on the end here, if you have any questions, feel free to throw it in the Q&A, and this can be questions on these different loan types or anything that you got. Happy to answer, and we will in a second here. So we're going to go rapid fire on a couple bonus ones. FHA 203K loan. This is essentially an FHA loan that allows you to fix up the property that you're going to live in. And so we've had some clients use this for, single families that they want to actually raise their family in, right? Where you get an FHA 203K loan, they give you the funds to purchase the property as well as the funds to actually get it rehabbed and done. The only piece with this is everything has to be done by a licensed contractor, which is good, right? But you have to have that person lined up ahead of time. The bank needs to review that, approve that contractor. And then the only way you actually get draws is if the bank sends somebody out to look at each section that they complete. And so I say all this to say that using an FHA 203K loan is going to take that project way longer than you think. If you think it's going to be 6 months, I'd budget 12 months. If you think it's going to be, 3 months, I'd call it probably, 8 or 9 months, only because they just move slow with the money. And contractors tend to pause working if they're not getting paid along the way. And then when you look at bank statement loans, this is another one that's in the realm of DSCR. And I've used this a couple times in the past few years. And bank statement loans are awesome for self-employed folks who have a lot of money coming through the bank account, right? Like maybe they're getting, cash payments or Zells or things of that nature, but it doesn't all show on a tax return. With the bank statement loan, your interest rate is definitely going to be higher, right? But the way they work it is they essentially take the last 12 months of bank statements. They look at all the income that came in. That's all they're looking at, all the income that came in, right? They cut that income in half and they use that to qualify you. Cutting in half, they believe, will cover, most of the operational expense. Hopefully you don't need half to cover your operational expense. And then they will take the rest. So for example, say you're making, 100,000 a year, right? They're going to take those bank statements, going to equal 100,000. They're going to cut that in half to 50,000 and qualify you based on that 50,000 amount, which would essentially be, hey, what is, 40%, or 30% of 50K annually. That's how much this person can pay toward housing, and they're off to the races from there. The next one, hard money and private money. So this is one that you use when it comes to fix and flip, right? And one thing I would say is hard money costs a lot. So typically when you're doing hard money, your interest rate's going to be significantly higher. Like right now, you're probably between, 11, 13% on the interest. It's usually a shorter term loan. Typically they'll give you 6 months. And then if you go back to them, they'll let you renew if you pay some additional points. And typically you got to pay points on the loan. And so points are essentially like 1 percentage point of the loan. So if you have a loan for 400K, right? If you're going to close that, typically they'll take not only the down payment, but also some points on top just to make sure they're getting paid right off the bat. So the point may be, hey, we're going to take 2 points off of 400K, which would be $8,000, right? As well as the down payment. And that down payment, if it's your first one, could be 20% of the property, right? But the cool thing about hard money is they give you not only money to purchase the rest of the property, but the funds to actually get it fixed up and ready to rock and sold, right? So that you can pay back the lender and also make a profit. And so the key with the hard money is making sure that deal is locked tight and that it makes sense and sticking to the budget. Don't over rehab the houses, right? That's happened to me many times where you get into a project and you're like, you know what? Instead of doing, repainting these cabinets, let's go ahead and pull these out and do shaker cabinets. I think it'll look better. And then you look at all the comps and all the comps have, the previous cabinets. You didn't have to do that. You didn't have to spend the extra couple grand to make that happen, right? So that's super important when it comes to hard money. When it comes to private money, this is one where you're essentially going to the people in your circle, the people that know, like, and trust you, and putting together a deal that makes sense for all parties. And so the one caution I'll have about private money is just make sure this is not a handshake agreement. Make sure that you have everything on paper and that you guys have discussed everything up front, because this is truly like a marriage. It's a partnership. And you don't want to be with somebody who's going to be pounding on your door every 30 seconds if nothing's happened with that property, as well as traffic and things of that nature. And so definitely want to be careful with the private money. And then the last one I'll leave you with is a HELOC, right? This is not a purchase loan, right? It's fuel in your tank. It essentially is for the properties you already have, right? Whether it's personal or investment, you can actually go to the bank and get something called a HELOC, which is a home equity line of credit. And it allows you to use your home like a credit card up to X amount, right? And the interest rate on this is much less than credit cards, right? So I usually take out a HELOC on my primary, which I still have one. And I use that to lend on other people's flips, right? People that I know, like, and trust, that I've seen their track record to know that they're pretty good at this thing. And I'll use my HELOC to invest in their flips and just make sure the spread's enough. So for example, if my HELOC costs, 8%, and then I talk to this person, they're giving me 20% or 15% or 16%. I just make a decision on, hey, is that enough that I'm making moving forward, and go from there. We are going to bring it home with a simple decision tree. For your first property, if you are tight on cash or credit, we would recommend doing house hacking and probably going after that FHA, right? Depending on where your credit is, do the FHA 3.5% down up to a fourplex and negotiate hard for seller credits. If you have stronger credit and you want that PMI to disappear over time, we would recommend going with that conventional, right? Like 5% down if you're going to be personally living in it, maybe a little bit more if it's an investment property, and going from there. When you start scaling past your DTI, your debt to income, when you start getting to that, 10 properties or more, DSCR is the way to start exploring, right? Because there's no cap or limit on that. It's looking at the property itself, especially if you're in the residential space. If you served the country in any capacity and you are a veteran, VA loan, I can't tell you how many veterans I talk to that aren't taking advantage of this. And it frustrates me. I'm like, listen, you earned this. You were out there basically the front lines and you earned this benefit. You should use it. I know a lot of people using the school benefit. We need more people using the VA benefit when purchasing a house and getting it for zero down. And then buying a project, a home that needs a lot of work as your first property, that FHA 203K loan is a good way to go. Just keep in mind, it tends to frustrate contractors because of the delays in payment. And so it's good to have at least some funds up front so you can maybe pay them and get reimbursed. The last thing I'll leave you with before jumping to Q&A is if you want us to run your numbers and work alongside you to figure out which loan fits your situation and which strategy fits your situation, feel free to go ahead and visit ekabohome.com, schedule some time, throw something into the chat. We will connect with you and make it happen. I hope that everybody has an awesome Wednesday. It kind of feels weird, this being the first day in 27 where we haven't had some World Cup action, but I know we're going to be getting back into it tomorrow. And so I hope everybody is able to remain safe and enjoy the day. And I will catch you a little bit later.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence.